Interest rates part 2. In this video we will be seeing how what's the impact of different deposit patterns in an account compounded in a specific manner, and we will be looking at how mortgages work in Canada given the regulations about how they are being quoted. Okay, so here we compare different investment patterns. So someone has the possibility to deposit money in an account which interest rate is quoted as a 6% APR compounded monthly. A 6% APR compounded monthly means that every month 0.5% is applied on the balance in the account and is paid as interest to the account holder. What is the account balance after 10 years with each of the following deposit pattern in the account? So $100 deposited at the beginning of every month, starting today, for a total of 120 deposits. $600 deposited at the beginning of every 6-month period, starting today, for a total of 20 deposits. Or $1,200 deposited at the beginning of every year for a total of 10 deposits over the next 10 years. And $2,400 deposited at the beginning of every 2-year period, starting today. What's the value of the account after 10 years? So these are annuity dues. So we will have to compute the future value of 4 different annuity dues. And what is the future value of an annuity due? So it's the future value of a regular annuity. So the payment divided by the interest per period times, open the parentheses, 1 plus interest per period to the power number of periods minus 1. In this case, if there are 2 payments per year, so NP would be 2, and the number of deposit payments would be 2 times 10 is equal to 20. If deposits are made every month, NP is equal to 12, and 12 times 10 gives 120. And now the special calculation we have to make here is with respect to the interest rate per period. So even though payments are made once a month, 2 times a year, once a year, or once every 2 years, interest rate is always calculated monthly, which means if we consider semi-annual payments, we have to be able to use this equation correctly. We have to enter in the equation the appropriate semi-annual discount rate. And the appropriate semi-annual discount rate is the semi-annual rate that gives the same effective annual rate as the 6% APR compounded monthly. So first step, we take the quoted rate with the compounding period and we calculate the EAR. So the EAR, considered the EAR provided by this account is 6.1678%. That's the effective annual rate of the account where the money is deposited. Now we need to compute the equivalent monthly rate with monthly deposits, the equivalent semi-annual rate with semi-annual deposits, the equivalent annual rate with annual deposits, and so on. So the equivalent monthly rate with monthly deposits, we've had it from the beginning, so it's 0.5%. So 1 plus the monthly rate to the power 12 has to be equal to 1 plus the APR divided by the compounding period to the power of the compounding period. So here on the right hand side of these of each of these equations, we always have the same term. So that's the effective total return on the account. Now we need to extract the periodic rate that is consistent with the same effective annual rate. So if we make deposits in the account every 6 months, well, interest is calculated once a month. So every 6 months, whatever money is deposited at the beginning of a 6-month period, this amount of money here will earn interest at the rate of 0.5% 6 times before the next payment. So in a year, that means, so the semi-annual rate we are calculating here, which is 3.0378%, is consistent with the monthly compounding of 0.5% over 6 periods. Okay, so when we compute the effective annual rate, or the annual rate, which is consistent with the initial APR compounded monthly, so 16.78% is consistent with 0.5% compounded over 12 periods. And 12.716% is the rate that is consistent with 0.5% compounded over 24 periods. So what do we obtain? So the future value for each of these deposit patterns. So with $100 deposited monthly, the monthly rate is 0.5%. So times 1 plus the monthly rate, because it's an annuity due, gives us a future value of $16,478. If we do it with semi-annual deposits and the equivalent semi-annual rate, so that gives us a future value of $16,676, with annual deposits $16,925, and with bi-annual deposits $17,472. In this case, with the deposits being made at the beginning of every period, bi-annual deposits is the pattern giving us the greatest future value, because in this deposit scheme, bigger amounts of money are deposited earlier in the account. So more money earn more interest over time. So this is the pattern that gives us the largest future value when deposits are made at the beginning of every period. Now, if deposits are made at the end of each period, it's the opposite. So the monthly deposit pattern is the one providing the highest future value, because here money is on average deposited earlier in the account. So if we wait, so in the case of bi-annual deposits, since we wait 2 years before making the first deposit, so there are 2 years of interest on which we don't make any money. So we lose 2 years of interest, and the last $2,400 deposited in the account is not even making any interest. Whereas in the case of monthly deposits, only the last payment of $100 does not earn any interest at all. So when deposits are made at the beginning of a period, the biannual deposit pattern is preferred. When deposits are made at the end of a period, the monthly deposit pattern is preferred. Now onto mortgages. So regulations in Canada require that a mortgage rate be quoted with semi-annual compounding. But payments can be made monthly. They could also be made every 2 weeks. Okay, so any arrangement is possible, but most of the time the payment is made every month. So how to calculate the monthly payment from a quoted mortgage rate? Step 1, find the effective annual rate, which is consistent with the quoted rate compounded semi-annually. Once the EAR is known, extract the monthly rate, which is equivalent with the EAR we found in step 1. Once we have the monthly rate, which is consistent with the quoted rate, we can extract the mortgage payment using the regular annuity formula. So an example, find the monthly payment on a $300,000 mortgage quoted at 14% and amortized over 25 years. Step 1. Since the quoted rate assumes semi-annual compounding, so the effective annual rate associated with the quoted rate is 1 plus 14% divided by 2 to the power 2 minus 1. So slightly above 14%, 14.49%. Step 2. Find the monthly interest rate, which is consistent with an effective annual rate of 14.49%. So 1 plus the monthly rate to the power 12 minus 1 has to be equal to 14.49%. That gives us a monthly rate of 1.13%. Once we have the monthly rate, we just include it in the present value equation for an annuity. And this is a mortgage. So the first payments are not made at the beginning of every period, but at the end of every period. So when money is borrowed, the borrower does not instantly make the first payment. Money is borrowed, we wait a month for the first payment. So the present value equation is payment divided by R times 1 minus the present value factor to the power number of periods. What is the number of periods? 25 years times 12, because we are dealing with monthly payments. What's the present value of the loan? The value of the mortgage, $300,000. The monthly rate, 1.13%, is what we have calculated in step 2. And we are looking for the monthly payment. Note here that the monthly rate of 1.13% corresponds to the internal rate of return of the mortgage. So the present value of the mortgage is equal to the present value of all the cash flows. So the net, from the point of view of the borrower or the lender, the net present value of the mortgage is equal to 0. Okay, so for the lender, the present value of all future payments to be received is C over R, is the right hand side of the equation here. And what is the payment made by the lender at time 0? So the lender is giving $300,000 to the borrower at time 0. So from the point of view of the lender, the net present value of this operation is C over R times 1 minus 1 over 1 plus R to the power T minus P. Okay, and with having the equality between the two, the rate Rm corresponds to the internal rate of return of the mortgage at time 0. So we replace all the values we know by their number. So 300,000, 1.13%, 300 periods, and we extract a T. So we obtain a monthly payment of $3,510.61. Example 2, an entrepreneur is considering the purchase of an office in a new high-rise complex. The office is worth $350,000. And a bank is offering a mortgage of $230,000 at 75% APR compounded semi-annually. If the entrepreneur's budget allows for payments of $2,750 a month, how long will it take to pay off the mortgage? Okay, here, how long will it take to pay off the mortgage? Okay, not the purchase, the mortgage. Step 1, find the effective annual rate consistent with the 7.5% APR compounded semi-annually. The effective annual rate is 7.64%. Find the monthly rate consistent with an effective annual rate of 7.64%. Monthly rate is 0.615%. Once you have the monthly rate, so the monthly payment has been given to us in the question. It's $2,750. We have the monthly rate. We have the mortgage. We don't have T. We are looking for T, the number of periods it will take to repay the mortgage. So we can plug all these numbers, all the numbers we know at the correct in their correct spot in the equation. So this gives us line 2 here. And then we need to isolate T. T is an exponent. To isolate T, once I have something to the power T is equal to whatever, I take the log of something to the power T is equal to the log of whatever. So here we have log of whatever, and here we have log of the present value factor for one period. It's possible to put T in front of the log to isolate T. So that gives us 118 months. And 118 months is 9 years and 10 months to pay off the mortgage. Example 3. You need to borrow $400,000 to buy a house. Bank of Montreal offers a mortgage of 7.252% compounded semi-annuity, amortized over 25 years with monthly payment. What will the monthly payment be? Step 1. Find the EAR consistent with the quoted APR, 7.38%. Step 2. Find the monthly rate consistent with an EAR of 7.38%, 0.595%. Step 3. Plug in all the values we know in the present value equation for an annuity using a present value equal to the mortgage loan, an interest rate equal to the monthly rate consistent with the effective annual rate, and a number of periods equal to number of years for the mortgage times 12. Isolate C, and we obtain a monthly payment of $2,864.17. Same example, different question. So you borrow $400,000 to buy a house. Bank of Montreal offers you a mortgage at 7.252%, amortized over 25 years. What will the outstanding balance of the mortgage be after the first 5 years? Okay, we found the payment in the previous question. So the payment in the previous question was $2,864.65. Nothing has changed with respect to the interest rate period. Okay, what has changed here is the number of periods until the end of this annuity. So 5 years have passed out of the first 25 years of the mortgage. So 25 years corresponds to 300 months, and 20 years corresponds to 240 months. So 240 here is 20 times 12. Okay, or put differently, so 5 years is 60 months. We started with a 300 month mortgage. We have paid 60 months so far, so there are 240 months remaining in the mortgage. So what's left in capital to be reimbursed on the mortgage is equal to the present value equation consistent with all the parameters we have found so far: the payment, the monthly rate, the number of periods left. So here, if the borrower keeps paying $2,864.17 per month, the mortgage will be entirely paid after 240 months. Meaning, what's the amount of capital that still needs to be repaid after 5 years. That's the present value of the next 240 payments. So the outstanding mortgage after 5 years is $365,321.44. So not much of the $400,000 have been repaid after 5 years. So that's the trick of a mortgage. So at the beginning of a series of mortgage payments, so the payment of $2,864 pays a lot of interest and little capital. Towards the end of the mortgage life, then the monthly payment pays way more capital than interest. So the very last payment of $2,864.17 pays almost like a big chunk of almost exclusively capital and a tiny amount of interest. So okay, so that's the outstanding mortgage. Now, how much interest will you pay during the first 5 years? Okay, so we just calculated that out of the $400,000 borrowed, we after 5 years, what's left to be paid on the mortgage is $365,321.44, meaning during the first 5 years, the borrower has repaid $34,678 in capital. Out of 60 payments of $2,864, $34,678.56 went to repay capital, meaning the balance was used to pay interest. So how much in interest has been paid during the first 5 years? $137,171.